Buying call options is a strategy that allows you to profit from a stock's price increase without having to buy the stock outright. A call option gives you the right, but not the obligation, to purchase a stock at a specified price, known as the strike price, before or on a specific expiration date. This approach provides leverage, meaning you can control more shares for less capital. Here's how it works. Suppose a stock is trading at $100 per share, and you believe its price will rise. You buy a call option with a strike price of $105 and a premium of $3 per share. Each option contract represents 100 shares, so the total cost of the option is $300, 100 shares times $3 premium. If the stock price rises above $105, your option gains value because you can buy the stock at the lower strike price and sell it at the higher market price. For example, if the stock's price increases to $115 before the option expires, the intrinsic value of the option is $10 per share, $115 market price, $105 strike price. Subtract the $3 premium, and your net profit is $7 per share, or $700 total. This demonstrates the leverage of call options. You invested $300 but earned $700, a significantly higher return than if you had bought the stock directly. However, if the stock price doesn't rise above $105 before the expiration date, the option expires worthless, and you lose the $300 premium you paid. This highlights the risk of buying call options. Your maximum loss is limited to the premium, but the stock must move in your favor within a set time frame to make a profit. Call options are popular for both speculation and hedging. Speculators use them to bet on a stock's price increase with limited capital. For instance, if you expect a company to announce strong earnings, buying call options allows you to profit from a potential price surge without committing to buying the stock outright. On the other hand, investors use call options for hedging, such as locking in a price for a stock they plan to buy later. The price of a call option or premium is influenced by factors like the stock's current price, the strike price, time until expiration, and market volatility. Higher volatility increases premiums because the likelihood of large price movements rises. Additionally, the option's value decreases over time, a phenomenon known as time decay, which accelerates as the expiration date approaches. Buying call options offers several advantages. It requires less capital than buying shares outright, allows for high potential returns if the stock price rises, and limits your maximum loss to the premium paid. However, it also requires precise timing, as the stock must move above the strike price within the option's lifespan for you to profit.